Okay, before we jump in, new video has been added to the top-down section. So if you click on Applied Macro, top-down analysis, you will see it at the bottom over here, top-down rates and spreads. It's a long one. It's almost 3.5 hours, but that's what we need to get through everything that you would need to get through if you were doing a top-down analysis and looking at the rates market and working your way down from rates to the market itself. So that's available. Let's also not forget, let's click on home again, and let's not forget that we have our hat sale still going on till December 15th. All proceeds for each hat sold, not only do I donate the amount for the hat sold, I also match it for the hat sold as well. All of the proceeds go to Pathstone Mental Health this year. Okay, let's head on in. Okay, before I start with the normal first screen, I start with the nominal rates. I thought we would review Powell's comments from November 30th. He gave a speech at the Brookings Institute and then took some questions. So we'll go through a few screens. We'll review his comments because we'll be able to view how the week ended in a little bit of a better context, a more critical context, if we have this behind us. After his speech, the market rallied 100 points, went sideways pretty much on Thursday, and on Friday, after the jobs report, futures dropped considerably, and then from the open just continued to gain their ground all the way back to end with a gain on the day. So we have to ask ourselves, is that consistent with what he said? Or is it consistent with what the market wanted to hear? They can be two different things. Okay, so he starts off, his very first sentence, he says inflation remains far too high. And he ends his first paragraph by repeating inflation remains far too high. So he said it twice. Points out that the October PCE is a single data point. Also notes that past down months, because we have seen that before, past down months have been followed by up months. So we need substantially more evidence. This is consistent with what they've said in the past, that they are not, that they are data dependent, not data point dependent. And I had mentioned this as well, that the PCE that we were going to see was going to be consistent with CPI. These are not two separate data points, the CPI and the PCE. They are two different ways of measuring the same thing. So it is the same news. CPI is lower. We would expect PCE to be lower. It's not another reason to throw a party because, oh look, we're looking at the same thing differently and it's the same thing. Throw a party, right? Rather than issuing forecasts, because he dismissed inflation forecasts and points out quite rightly that professional forecasters have been all over the place. If you think about the distribution of forecasts, some of them are bound to be right purely just by the distribution. But because there's such a distribution, there really is no science behind this. So rather than follow forecasts, he points out that it is easier to describe the macro conditions that would be needed to see inflation at a 2% target. Number one, raise rates to a sufficiently restrictive level. And later on, he gets a little bit more clear in the Q&A when he talks about a restrictive level, that it's not just the policy rate being greater than the neutral rate, it's other things as well. As far as what is sufficiently restrictive, he does follow it by saying there's considerable uncertainty, not just uncertainty, considerable uncertainty where that is, but somewhat higher than the September summary of economic projections. The December meeting, we're going to get a new summary of economic projections, so we'll see what the updates are there. As for September, the SEP had 2022 ending at 4.4. There is a strong belief that we're looking at 50 basis points in December to end at 4.5. Ending 2023 at 4.6, and we will see when we look at Fed funds futures for December, it is exactly at 4.6. Considerable uncertainty, somewhat higher than the September summary of economic projections, and the market heard, oh, you mean the same as the September economic projections? 2024 is 3.9, 2025 is 2.9. Another condition, slow the growth in aggregate demand, so we need to see a sustained period of below trend growth. By the way, it is worth pointing out that GDP now for Q4 is 2.3%. As more data comes in, it does get a little bit more informative because it's model driven at the beginning of the quarter, so it really is going to sit with what the belief of trend GDP is, and then as new data comes in, it either increases or decreases that. It was over 4%, 4.6%, and 2.3 now. Powell goes on, he didn't say this, I'm just adding this in now. They want to see a sustained period of below trend growth. They have seen slower growth in some sectors, but little overall effect on inflation. Okay, he goes on to then break down core PCE into three different groups: core goods, housing services, and core services ex housing. For core goods, he notes that it has been coming down, but it is still elevated year over year, but believes that it will continue to drop and that it will help because it'll print some negative numbers while other categories are printing positive numbers, that it will help in bringing overall inflation down. Housing services are still rapidly rising and will continue well into 2023. And they are looking at price inflation of new leases. So they're not looking past it saying the base effects will wear themselves off. They're looking at new leases. And if you have the applied series, we on the sector studies for REITs, for apartment REITs, I went through this showing how if somebody is staying in an apartment for another year, there is a small increase, but if they leave and they get a new lease, the increase is dramatic because the rents that were set 12 months ago are repricing to today's market rates and they're higher. And Powell notes that as well, that they're resetting to market rates at higher prices, and that's going to continue for some time. They have to get that down. So they're not going to look past housing. But they are looking at price inflation of new leases. They do expect it to decline in 2023, but later in 2023. So this is not going to go down anytime soon, at least based on what they feel. And core services ex housing, they've seen no clear trend. So core goods, they say going down. Housing services going up, but they do expect later in 2023 for it to come down. For core services ex housing, they see no clear trend. It is the largest, making up about half of the core index, and wages make up the bulk of the cost. So the labor market is key. These are his words. Labor market is key. Notes that demand far exceeds supply. Nominal wage growth is well above what would be consistent with 2% inflation, saying you must see at least 1.5 to 2% drop in the ECI. Therefore, they need to see restoration of the balance of supply and demand, but labor shortages are unlikely to close anytime soon. The current shortfall, he estimates, is about 3.5 million workers. This is a result of both lower population growth and lower participation rate. Of the 3.5 million, he estimates that about 2 million are the result of excess retirements. In other words, we do expect a certain amount of retirements, but we're seeing even more retirements. And 1.5 million of the shortfall is a result of slower immigration plus the cumulative effect of pandemic deaths. He notes that policy can't fix the participation rate. Therefore, a moderation of labor demand growth is needed. This is, I think, an interesting point he made here as well. Even with lower job gains over the past 3 months, was still far in excess of population growth by about 100,000 a month. So there is a certain amount of job gains you need because of population growth just to hold the labor market in balance. If it were in balance, you would still need job gains because of population growth. So he's saying right now that the lower job growth that we're seeing over the past 3 months is still about 100,000 more than what would be necessary given population growth. So even if you get the job gains per month down by about 100,000 per month on average, it still wouldn't do anything to help the the supply-demand imbalance. You'd have to get it even lower than that because demand for labor is outstripping supply. So every month that we're over 200K, we're actually getting worse and worse and worse and worse. It has to be somewhere below 100K per month to start, just to get in balance by basically by what he's saying. Well, about 100,000 per month to just to get in balance, and so it's not making it any worse. So yeah, you would have to be less than 100,000 a month in job gains to start improving the balance. Other conditions here: real GDP less than trend and sustained, seeing supply bottlenecks easing and continuing to do so. Housing, new lease inflation needs to fall and continue to fall. And labor, these are his words, we have a long way to go. That's the big one, which is why after the jobs report on Friday, the market, the futures market, at least in Globex, just dropped across the board and then just decided to ignore that. And we'll look at the jobs report and we'll see that it was everything that Powell does not want or did not want. Everything that could go in the opposite direction could. That if you had to bet on a jobs report being exactly opposite what he wanted, it was a tough bet to make, but that's exactly what you got, the trifecta. He talked about FOMC policy. Ongoing rate increases are appropriate. The full effect of tightening has yet to be felt. Therefore, it makes sense to moderate the pace of hikes. May come as soon as December. The focus is shifting from how fast we're raising rates to how high are we going to raise them and how long they're going to stay there. And then he said they will stay there for some time. And then he ended his speech with this quote. And I think the market is a little complacent about this quote because he said it a number of times, and I do believe this will be the guiding star. History cautions strongly about prematurely loosening. We will stay the course until the job is done. So how the Fed funds futures is pricing in, at least after the jobs report, started pricing in lower and lower rates by the end of December. The only condition under which I could see that is if the belief of a recession was elevated. Then, yeah, at some point they would have to cut rates. But if it was just on his comments alone, I do think that the market is underestimating that this really is their guiding star right now. The Q&A. The Q&A, I think, is where, because while he was speaking, the market was up, down, but not really going anywhere. It was during Q&A that the market really started to take off. He's just bad at Q&A. I mean, he really should just read a speech and leave the stage. But I think he said some things that, on hindsight, looking back, he probably didn't want to even open the door. Because if you open the door and then have a whole bunch of buts, the market doesn't hear the buts. It just sees the open door. Because he opened a door and then followed it up with but the market didn't hear the buts. He says there are positive signs inflation and job openings are declining. We could get a drop in job openings without having to produce unemployment. Labor supply, deglobalization, climate change. This was brought up as potentially reducing the elasticity of supply. And the question was, is this the new normal? And he said, I don't know. He didn't say it that way. He said, we don't know. We don't know. What does this mean, reduce the elasticity of supply? And elasticity is a sensitivity. It is the change in supply for a change in demand. So if demand increases, you would expect supply to increase. But if these things here reduce the elasticity of supply, as demand increases, supply would increase by less than it normally would. thereby creating persistent shortages in the marketplace because of reduced labor supply, because of deglobalization, and because climate change can sometimes shut down certain areas of a country for a period of time because of flooding, tornadoes, destruction, damage, coastal flooding, things like that. So is this the new normal? Should we expect a prolonged period of inflation simply because of this reduced elasticity of supply? He says, we really don't know. However, we assume things will go back to the way they were. This is not really a good assumption for what are called complex adaptive systems. And economies are complex adaptive systems that if you add something to a complex system, you create something new. You create something new, and usually you have something new here. You have an emergent property. That means that there's this property in this new system that you cannot reduce to what it was before. So that by taking something away, you don't simply return to the state you were in. You are affecting this whole system, and you'll have some new properties that emerge. But for the most part, you're going to have to break things if you decide that you're going to go the other way. So adding something to a complex system is not the same as taking something away from a complex system. So this assumption that things will go back to the way they were, I think, is linear thinking when you're dealing with a system full of non-linearities. Financial conditions. Restrictive is not just the policy rate being greater than the neutral rate. We want to see significant real rates across the curve. It should say significantly positive real rates across the curve. Well, from the time he spoke to Friday, real rates dropped. We look at credit spreads. Since the time he spoke, credit spreads shrunk. We look at exchange rates. From the time he spoke, exchange rates dropped. And we look at asset prices. And from the time he spoke, asset prices increased. So he wants to get to restrictive. And he's saying, we don't just look at the policy rate being greater than the neutral rate. We want to see significant positive real rates. That worked against him. We want to see, we look at credit spreads for the availability of credit. Well, credit became more available. We look at exchange rate. Well, exchange rates dropped. And we look at asset prices. Well, they've gone up, not down. So almost everything that he described as what he would look at other than just the policy rate has moved against him since that very speech. He had a question about the balance sheet. He noted that the Fed is in an ample reserve regime. There's lots of room to shrink, and they're going to continue to shrink. They want to get it down, and he was unambiguous about that. Asked about a recession, and I think this is where the market decided that, nothing else matters because of what he said. Still thinks there's a path to a soft landing. Unemployment going up, but not much, and inflation goes down. That's what he sees. We see unemployment going up, but not by much, and we see inflation going down. Quote, I think that is very plausible. But, he did say a but. If you look at history, it is not a likely outcome. This is what the market heard and then left the room before the but. I think that is very plausible. Unemployment can go up by a little, inflation can come down, we get a soft landing. Sure, yeah, I agree. But it's not a likely outcome. They didn't hear that part. We don't want to over-tighten because cutting rates is not something we want to do soon. I think they heard this. We don't want to over-tighten. I think that is very plausible. We don't want to over-tighten. Well, what's not to rally on? But it's not a likely outcome. Why don't you want to over-tighten? Because cutting rates is not something we want to do soon. I don't think they heard this point. Cutting rates is not something we want to do soon. That is why we are slowing down. They don't want to go too far and then have to cut. They want to go far enough and hold it there for a long period of time. We will not get back to pre-pandemic participation rates with an aging labor force. Therefore, most of the balancing must come from the demand side. But really just by slowing job growth rather than putting people out of work. And I think they heard this but. You know, they kind of, because I'm trying to figure out why would you rally? Well, that's worth rallying on. I think that's very plausible. We don't want to over tighten. We just want to slow job growth rather than putting people out of work. You know, when you make those kind of statements and you put them out there in the world, they're going to get used. However, yeah, it's not a likely outcome. We don't want to cut rates soon. Sort of should counter that, but it didn't. All right, we're right near the end of the Q&A, and this is where he just kept saying very dovish things. We are in a place now where we can really get inflation under control. As far as a question about real wages being negative, he implied that that is actually a good sign by saying if you get to the point where workers ask for real wage gains, you are in trouble. We don't think we're at that point yet, because if you get to this point, then you have the wage price spiral. We're not there. We're in a place where we can get inflation under control. A soft landing is completely plausible. We don't want to over tighten. We think we could just slow job growth rather than putting people out of work. And then when somebody from JP Morgan said, why not just do shock and awe and get it over with? We don't want to crash the economy. The Fed put back on the table. All right, with Powell's comments behind us as a backdrop, let's start going through the rates. And some peculiarities here, some things that I just can't square. You have markets, I think, in certain parts of the markets that we'll look at, whether it be rates, equity prices, futures, the VIX, the dollar, sort of telling different stories, and I'm not sure which one is winning. I think it probably represents an equal split right now between the bullish and the bearish camp. Let's start with what we know. We have an FOMC meeting on December 14th. That's in 10 days, and I don't think it's surprising that the expectation pretty much is for 50 basis points. And we would think that money market rates would begin to reflect the 50 basis points. And based on the dovish stance that Powell took in the Q&A, it would seem that the longer end of the curve would reflect lower inflation expectations, which it does. The 2-year to the 30-year, all capital market rates have dropped, and I think they've dropped, reflecting the belief that we are going to get a soft landing, which is a low growth environment with lower inflation. So rates are dropping in anticipation. I think that they're dropping because the inflation expectation is coming out, not so much any plan to drop rates. Although, once we look at Fed funds futures, that doesn't seem to be the case. The curious part is in the money market rates. Again, 10 days away from the 50 basis point hike, and look at the 2-month to the 1-year. They've dropped. The rates have dropped out. The 1-month is the most curious. These are constant maturity rates. So the 2-month here, the 2-month rate is going to incorporate the December 14th FOMC meeting, and it's going to catch just the February 1st meeting as well. And for it to pull back 8 basis points in front of what it will cover as 2 FOMC meetings seems rather curious. This is curious as well. This is the closing of December 2nd. So the 1-month rate should reflect 10 days of the target rate between 3.75 and 4. And because it's a 30-day, should reflect 20 days of the rate being between 4.25 and 4.5. Last week it was 4.16. That made a lot of sense. So you have that would have been a weight of 17 days on the lower target rate and 13 on the upper. Well, now you have a weighting of 10 and 20, so it should have moved closer to 4.2, 4.25, and instead dropped 25 basis points to 3.91. And the drop of 25 is way outsized compared to the 2-month, compared to the 3-month, compared to the 6-month. 25 basis points, that's huge. That's 3 times the move that the 2-month made. Well, you got to find a reason for this. So there are 2 reasons lingering in my head. Number 1, end of month, November 30th, maybe it was mutual fund money market positioning. If I look at the Fed balance sheet for December, 60 billion has to run off on the balance sheet. 53 and change billion is in bonds later in the month, which means T-bills would make up about a little under $7 billion. There was 18 and change billion of T-bills maturing on the 1st. So if you said, well, let's retire 7 billion of that because we got 53 billion of bonds coming that'll be retired, there's our 60. You had 12 billion that had to be reinvested. The Fed is a price and rate insensitive buyer. Could it be that all 12 billion went into the 1 month and pushed the rate to 3.91 ahead of what is expected to be a rate increase of 50 basis points, that they lowered the rate on the 1 month by 25 basis points instead? That would seem odd, because that would only place more need on the reverse repo facility by taking 1 month T-bills out of supply. That if they wanted to roll over, it would have made more sense to go into the 3 month and the 6 month and leave the 1 month for the market to reduce the reverse repo facility, of which they're paying interest on. Why would they pile into a security, not pay attention to the yield they're getting, only to sentence themselves to paying that $12 billion in the reverse repo facility at the higher rate that they're going to get on December 14th? It makes no fiscal sense whatsoever. And if that's what they did, someone needs to lose their job for doing that. So I don't think it's the Fed moving into the 1 month. But, my friends, I've got a big question mark on that. So if somebody has a reason, some technical reason why, because it's not fundamental and it's not an expectation. There is some technical reason why that something had to be bought anyways by somebody somewhere, and that's what caused it. I don't know what it is. December 13th, I think, is the more important day. I think December 14th is in the books. Really, I don't know that there's going to be much of a surprise unless December 13th surprises. But right now, I think we're probably looking at 50 for December 14th. CPI is December 13th. That's in 9 days, and that is the question mark because, well, it's not like it's set by anyone. It is just the result of a measurement, and who knows what we're going to see. We can, start thinking about what it possibly could be. A little later on, we'll look at that, but right now, it's just a question mark. Let's look at yield curve inversion, and I did do some digging around into some papers, some academic papers, to see if I could find a clearer explanation of, the mechanism that goes from yield curve inversion to recession. And what I'm going to present to you is the best that I found so far. We look at the 2s and 10s, negative 77. That is a new low. That is 151 days we've been inverted. And for this inversion cycle, that's a new low for this inversion cycle. You got to go all the way back to August of 81 to get a deeper inversion. That was 132 basis points. If you take that out, you got to beat February 80, which was an inversion of 201 basis points. The 3-month to 10-year is inverted 83 basis points. That is now 39 days inverted. It is a new series low. So the 3-month, 10-year series on Fred goes back to January 4th, 1982. It's never been lower. 83 basis points throughout the whole series. The 2-year, 10-year slope can invert in both a high growth and in a low growth regime. Inversion in a high growth regime is the market signaling that it expects the economy to move into a low growth regime. This typically happens in late expansions when the economy enters a slowdown phase. The 2s to 10s will invert, but not necessarily the 3-month to the 10-year. So the 2s to 10s will invert if we're in a high growth environment, and we expect that we're going to be in a low growth environment in the next couple of quarters. It will invert. But the low growth environment doesn't necessarily need to lead to a recession. It could simply be a lull in growth for some economic shock reason, and the shock disappears and we go back to a high growth regime. Which is why an inversion of a 2 to 10 doesn't always lead to a recession. But an inversion of a 3-month to 10-year does, because the 3-month 10-year inversion typically only occurs in low growth regimes, or what are called low consumption regimes. Combine that with the fact that recessions typically occur due to some shock. It is not just the business cycle has gone on for too long and naturally it just causes a recession. There's an expression that economies don't die because of old age. It requires some external shock. And it is that shocks in low growth regimes result in a recession, but a shock in a high growth regime might just move it to a low growth regime. So if we're looking at slopes and we see the 2 to the 10 inverted, but not the 3-month to the 10-year, it is because the economy is expecting a move to a low growth regime, but not a recession. If we are in a low growth regime, it is more likely that the 3-month to 10-year will invert, and if we get a shock, it'll push us into a recession. And shocks happen all the time. They don't cause recessions all the time because growth is strong enough to absorb it. So a good analogy is, think of a healthy person that gets the flu. It'll make them less healthy, but it won't put them down. It'll slow them down, but it won't put them down. Now think of an unhealthy person who gets the flu. That'll put them down and out of commission for a while. It's the same with the economy. A healthy economy can take the hits. A low growth economy, we wouldn't call it unhealthy, but a low growth economy cannot take the hits. If you do get a hit, it pushes you into recession, and a recession has a way of becoming even more self-fulfilling because once it begins, companies take a lot more action with a small change in growth to the negative side than they would to the upside. There is I forget the name of this theory, but that to cause a big increase in unemployment, you only need a small increase to get it started. Something like if you get like a 0.5 point increase in unemployment, you'll get a 2% increase in unemployment because you hit some tipping point where it just accelerates. Well, that's what a shock can do in a low growth regime. So the proper thinking about yield curve inversions predicting a recession is not quite correct. It's the yield curve inversions predict the type of environment in which a recession is most likely to occur, because these kind of shocks, economic shocks, happen all the time. So that if you are inverted in a low growth environment and you're inverted long enough, eventually a shock is going to happen, which is why we say we look at duration times depth. The longer you're inverted and the deeper you're inverted, the more likely the recession, because a shock is most likely going to cause a recession. So what is important now is the 3-month to 10-year, because we know we're in a low growth environment. So we have an inversion here, which means if there is an economic shock, it is most likely going to cause a recession. Is this inversion going on here in response to the Fed is going to have to lower rates because it is going to cause a recession? Or is it, no, we're going to have a soft landing and inflation expectations are going to disappear? We look at equity prices, we look at the dollar, we look at the VIX, it believes the second argument. Fed balance sheet, down $32.9 billion ending November 30th, now sitting at $8.076 trillion, with $60 billion in runoff on U.S. Treasuries and $35 billion on MBS. We never get to $35 billion because the prepayments have slowed down, so the principal isn't enough. We might enter January with a 7.9 something on the balance sheet. Last week was 8.109 trillion. This was done with a $21 billion drop in treasuries, $13.3 billion drop in MBS, but tips went up $1.6 billion. I don't think they bought $1.6 billion. I think this is just the repricing of the principal due to inflation. Probability for December 14th, 78.2% on a 50 basis point, just 2.4% more than it was the week before. Given the party that Wall Street threw for the equity markets, given the almost certainty of 50 basis points, I'm surprised this is still only sitting at 78.2%. You still have a fair weighting on 75 basis points. So roughly 80-20. There's still some weight on 75 basis points. We'll see if this moves closer to 100% as we move closer to December 14th. I think it might be cautious. There might be a certain amount of uncertainty here until this number gets behind us. We're not going to get too much help from Fed speak because it's over now. They're within their quiet period before the meeting, so there is nothing to talk the market down. All we have are Powell's comments that I don't think he really meant the market to hear just that. I think the market, again, is ignoring all the other stuff he said and focusing on just those nice rosy comments. This is odd as well, February. 75 basis points, 100 basis points, 125. This is from where we are now. In other words, the probability of 75 more basis points hikes from where we are, which would include the December and the February meeting, 46.1%. So that is 50 in December, 25 in February, and the equity markets believe full stop. That's it. That's where we stay, and that's where we'll be throughout the year. But there is almost equal weight on 50 and 50, or 75 and 25. Almost equal weight on that. Fed funds futures does have something more than 75 basis points priced in, but something less than 100 priced in. They're somewhere in between there on the Fed funds futures, but that has actually come down since Powell spoke. It was higher before he spoke, but it's actually come down a little bit. And you still have 9% here on 125, which would be 75 in December, followed by 50 in February. Okay, let's look at real yields. Huge drop in real yields. So is that drop because inflation expectations have increased, meaning that you'd rather have a real yield bond than a nominal bond? Or is it because the belief that interest rates are really going to drop next year because there's a recession, so real yields are pulling back? It's hard to tell. Let's go with the inflation expectation being too low. If we think it's a recession and real yields are dropping in anticipation that the Fed is going to drop rates to protect the economy, then the change in inflation expectations is just an artifact. It has no informational content. If we think that the market is smarter than that, saying, no, let's pay attention to the break-even rate because we should at least pick between a real and a nominal bond. We should look at the inflation expectation. If the inflation expectation is too low, if these break-even rates are too low, it increases the demand for tips. And in increasing the demand for tips, that will push real rates down because you'll have buying, which pushes the price up, which pushes the yield down. So let me just give you an example. Last week, the 5-year nominal yield was 3.85. The 5-year real yield was 1.51. You can see that up there. That made the break-even 2.34, which you can see in break-even rates under the 5-year column. If the market believed that, hang on a second, 2.34% average inflation over that 5-year period is way too low, and because it's too low, I'd rather have tips than nominal bonds, the 5-year inflation expectation being greater than 2.34, 5-year tips would be in demand. That would push the yield down, thereby pushing the break-even rate up. Because if 2.34 was too low, that break-even rate has to move up. Moved up to 2.51. Is that what we're expecting? Now, let's think about that. Let's say that that is exactly what the market did. Inflation expectations were too low. Over the course of the last week, inflation expectations have increased. However, Powell did say we're in a place where we think inflation will come down, and we're going to start moderating the pace, and the equity markets believe that. And the long end of the Treasury curve seemed to be coming down because of inflation expectations being lowered. If that's the case, then this here seems to be at odds with that. So I can't square that. It could be it could be that the real rates are dropping because of perceived recession on the horizon, where the Fed will have to drop rates, and that any change in break-even rates is just an anomaly. But if we go with the no, it is market thinking that the inflation expectation was too low, and if the inflation expectation was too low, why would the nominal yields drop and not increase if the thought was the expectation was too low? Why would it not be repriced into the long end of the curve? Again, question mark. It just doesn't seem to square. Let's move over to Fed Funds Futures now, and another question mark. So in reviewing Powell's comments, he did say that the rate at which they're going to, let me back that up. He said, let's ignore the pace at which we're going. That's not important. What's important now is how high and how long we're going to be there. As for how high, he said higher than the September projections. The September projections ended 2023 at 4.6%, which is odd, because he's saying somewhat higher. You would think that Fed Funds Futures would have priced it higher, but in fact, the market heard, oh, you're going lower. And he did say we're going to hold it there for an extended period of time, and the market heard, oh, you're going to hold it there for a shorter period of time. I don't know that you could have gotten it more wrong. He said it'll be higher than it was in the September summary of economic projections, and it will be there longer than you think. And the market instead heard, no, you'll be cutting sooner, and the rate will be lower. So let's just have a look at what happened over the course of the week. Let's look at the December rate right now. 4.6 was September. He's saying it will come in higher. Last week, the futures index was at 95,295, which implied a rate of 4.705. That seemed to be in line with the belief that we should be higher than what the September SEP was saying. After he said it, the market then moved the index to 95.505. This is as of the end of December 2nd, implying a rate of 4.495, which is lower than the 4.6. And as far as where it peaks, last week, June and July, the index was 94.995, implying the rate peaking at 5.005% sometime in June or July. After he spoke, they said, okay, it won't peak in June or July. How about May or June? It'll peak sooner and lower. So the index is now 95.085, implying 4.915. So his higher for longer is lower for shorter. Again, big fat question mark on this. I don't know what the market was thinking. I think the only way I can square this is that they zeroed in on his dovish statements, and especially that last statement, we don't want to destroy the economy. And I think that the market is saying the Fed put is back in play. They're not going as high as they want to go because the economy is softening. They're going to lower rates. They're going to stop. They're going to stop QT. And we're back in this wishful thinking phase again, when he was very clear. He opened his statement, inflation is far too high. Inflation is far too high. Said it twice in the same paragraph. Said the focus is on the labor market. Wages are way too high right now. We will hold the course till the job is done. History warns against cutting too soon, and yet here we are. Again, here we are. Instead of 5.05, no, it's going to be 4.95. Instead of June to July, no, it's going to happen sooner, May to June. Instead of 4.6 at the end of the year, which the Fed is saying it should be higher, no, it will be lower. Now, if you are expecting by the end of Q1 that the economy is deteriorated so much that you are in a recession, This, all of this is logical and consistent. But if you expect inflation just simply to disappear over time, and you believe them that they need to see more than one report, but a series of reports, if you take them at their word that they are going to move to restrictive territory and hold it there for a long period of time, this appears to be openly fighting the Fed, saying again, as we did in the summer, we don't believe you. Again, you know, collecting in the parking lot, calling the Fed out of the club, you know, for another fight in the parking lot. I just can't square these two things together. The secured overnight funding rate should follow the Fed funds rate rather closely. 1 month, again, May to June, is the low in the index, 95.11, which puts it at 4.89. For the 3-month term, March to June, 95.12, 95.13, puts it at 4.87. So consistent with Fed funds futures. But Fed funds futures don't seem to be consistent with what the Fed said. It seems to be consistent with only the dovish things the Fed said. But every time he said a dovish thing, it was followed with a but. And I don't think they just ignored the buts. Unless what he said was hawkish and the but was dovish, then they paid attention to the but. I think they were expecting, you know, brimstone and fire like they had in Jackson Hole. And when he came out kind of folksy and conversation-y and said, oh, we don't want to hurt the economy, we think we can get it done, I think a soft landing is very plausible, I think they just ran with that. Okay, here is Treasury volatility. You see your 30-year Treasury volatility on the far end of the curve here. This is all the way to December 2nd. We can see that, you know, right into the close on Friday, volatility dropped. The 2-year has gone sideways or increased slightly. Every other volatility has dropped. If we are near the end of a rate hiking cycle, this is consistent. So it seems that volatility is pricing in a 50 and a 25, is pricing in the end of the rate hiking cycle, is not really looking for those big outsized moves anymore, but smaller rate increases ending soon. That is consistent. So based on everything that we've been through, I am sort of in a position where I have a fixed income trade that's going to win no matter what happens. Long December Fed funds futures. Now on the previous screen I showed that, you know, it actually went lower. The Fed was looking for 4.6 as their end rate for 2023. It is sitting at 4.5 right now. That, you know, if we believe the Fed, it should be higher. I think 4.5 is probably too high. So I'd be long the Fed funds futures, and I think it's too high because I'm in the recession camp, not the inflation expectations and soft landing camp. I'm in the recession camp. And it, you know, it really doesn't matter what camp you're in. If you think inflation is going to disappear rather quickly, the Fed is going to lower rates closer to what they believe is a more neutral rate of 2.5. If it's going to break the economy, it's going to break the economy probably in the first or second quarter. Something will occur that breaks it there. I don't think you can go a whole year and a half in a low growth regime. We've been through 6 months of low growth regime. How long do you expect it to continue without a shock hurting us? I think that's the more likely outcome, is that we will be pushed into a global recession and rates will have to come down considerably. So being long Fed funds futures, I don't think has much downside. Even if the Fed funds futures goes to from 4.6, let's say that we end at 5, that the index goes to 95 from 95.5. With each contract, that's a loss of about $20,080. Sorry, $2,080. A loss on that contract of $2,080. But for every 1% up, it's a gain of 41.67. So if you think that they're going to lower rates considerably over next year because of a recession, there's a lot more upside than downside. Add duration, 20-year or 30-year. You can add duration here because if I think there's more risk to rates dropping than increasing at this point because of heightened recession risk. You can go out to January 2024 and buy calls on TLT. I don't know that you want to sell any puts with volatility coming down. Premiums are coming down, making buying options rather inexpensive. And I would step into a risk reversal or step into a spread depending on what happens. So I would start with long calls on TLT. If you get a pullback, you can sell puts at a lower strike and a higher volatility. So TLT is somewhere between 105 and 107 right now. So if you buy 115 calls for January of 2024, it's going to cost you money. But whenever you buy calls, you should buy more time than what you need. If you sell calls, you should sell shorter periods of time. Then I would wait. If TLT goes up, you're making money. If TLT goes down, it can go down, 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 and you could go, volatility will increase, which means premiums will increase. You can go and sell puts at much lower strikes than you could if you tried to put them on at the same time. In other words, if you tried to finance your calls with short puts now, you'd be very close to the 105, 107. You'd probably be about 100, maybe 98 to 100. Actually, if you're going out to 2024, you'd be the 95s or the hundreds. But if you wait for a pullback, if there is a pullback, you get the benefit of paying for these calls at a strike that is much lower, which means your margin will be much lower. Plus, you'll get the higher volatility, which means you can go even a little bit more lower because the premiums will be higher. So step into a risk reversal. Or if it just keeps on going up and up and up and up and up, at some point you can go to the 135s and you can sell the calls at the 135s for the same price you paid for the 125s, thereby getting a risk-free position of $20. Step into whatever position you want. Any curve steepener trade, I think, makes sense if you have a long enough time frame. How you get a curve steepener trade is you go long something with a low duration, you go short something with a high duration, and you make it duration neutral, so that if the curve shifts parallel, you're protected. But what you're hoping for is the curve to steepen, and if the curve steepens, you'll lose a little bit over here, but you'll make a lot over here. Let's look at credit spreads. Remember, another thing the Fed wanted was for credit conditions to remain tight. So that means credit spreads wide. Well, credit spreads have come in. If we look at what's going on here, -3, -1, -1, and especially on CCC, -73. This is not a sign of an impending recession. This is a sign of a soft landing over here. That's telling a different story. And look at the difference from the height here. You have OAS on July 5th hit 600 basis points. You need to see about 800. That's recession level. It's now sitting at 448. This was 12.89, sitting at 11.18. This is interesting as well. U.S. high yield, a broad index of high yield. OAS is 448. You go to Europe, the Euro area, high yield. Now this is not high grade, this is high yield. It's 506. It's only 58 basis points higher. I find that rather curious. I would have thought that it would have been a lot wider than that. I think there is some complacency in the credit markets. However, it could also be a function of significantly reduced supply. And if you have credit strategies out there, well, you gotta have bonds, or you gotta have some sort of credit derivatives in there. So being that there's a shortage of supply, it could simply just be reflecting that. Okay, so far we've seen that the change in real yields is not what the Fed wants to see. The change in credit spreads is probably not what they want to see. Maybe the jobs report had a bunch of good news for them. In the jobs report, they would like to see supply increasing, and they would like to see the wage inflation decreasing. And you get supply increasing if the participation rate increases. They'd also like to see jobs gains moderated a bit, still positive but lower. Well, they did not get any of those things. In fact, they got quite the opposite. So here's the household survey, and where are we here? This is from the establishment survey down here. All this stuff is from the establishment survey. So household survey, civilian labor force. The labor force contracted by 186,000. That's going in the wrong way. Participation rate contracted by 0.1%. So that is causing supply to decrease. If we look at average hourly earnings, 32.82 over 32.64, if you take the difference and annualize it, that is 6.82% per year annualized. If you look at, this was for November over October. October over September was 5.68 annualized. Over August was 4.93, then 3.4, 5.75, 5.38. So it was going in the right direction. 5.38, 5.75, dropped to 3.4, increased back to 4.93, then increased to 5.68, now is increased to 6.82. This is going in the wrong direction. To look at longer moving averages instead of 1 month, because 1 month can have a lot of volatility in it month to month. Year over year is 5.06% or 5.1%, and that's what what Powell alluded to when he was talking about wage inflation being too high. He said it's running about 5% year over year. He said that's too high. That's if you take a 12-month. If you just look at the last 6 months, it's actually 5.32% higher. If you just look at the average of the last 3 months, it's actually 5.8% higher. And if you just look at the last month, it's 6.82% higher. This is not going in the right direction. This is going in the absolute wrong direction. If you look at the diffusion index, this is industries, anything over 50 means expansion, meaning that the industries in either total private or manufacturing are, if it's over 50, are increasing the amount of labor they have, not decreasing. So it is the percentage, how you get to the number, it's the percentage replying that they're increasing plus half the percentage that say, no, we're not going to do anything. And again, over 50 means that you're increasing employment on net. This speaks to demand for labor. We've already seen supply here moving down. Demand, anything over 50 is expansion, 63.5. This is for total private. This is the big one here, 63.5, well above 50, which means demand is elevated, supply is dropped, the labor force is contracted, the participation rate is contracted, and you have accelerating wage inflation, 5.06 to 5.32 to 5.8 to 6.82. Real rates, not what the Fed wanted. Credit spreads, not what the Fed wants. Nothing in the jobs report is what the Fed wants. In fact, if you had to bet against the jobs report coming out as everything it did not want, that would be a bet that you wouldn't take, because you'd have to get 3 or 4 things right. It's like going to the track and betting the trifecta. That's hard to do, picking 1, 2, and 3. This was it. This was that. That's why at 8:30 when this came out, futures markets just dropped from well over 400 or 4,000 on the SPX, and only dropped to about 4,000. Didn't really print in the 3900s at all. And you think, okay, well, that makes a lot of sense. But then to get it back during the course of the day, to just shrug it all off and say, I know they said they care about this, but we don't. I know they said higher, but we think lower. I know they said longer, but we think shorter. To just blatantly shrug it all off, at the end of the day, I'm looking at the market going, okay, I'm in on the fixed income. I know adding duration right now is probably the right thing no matter what the outcome is, but equities, I don't get that move in equities. Okay, initial claims. The Fed is saying that jobs market is key, so we're going to elevate jobs data as much as we can to the top of the pile. And what we're going to look at here, week ending November 26th, 225,000 initial claims, dropped from 241, so it's a drop of 16,000. That's seasonally adjusted. If you look at the raw numbers, which is non-seasonally adjusted, It's an even bigger drop, 50,000. Went from 249,069 down to 198,557. This could be a function of legality. Typically, if you're going to lay off, you try not to lay off right in front of Christmas, just to avoid any potential legal action that could occur because of it. You try not to lay off in front of Christmas. So we have a number of reports for December coming up for the weeks ending the 3rd, the 10th, the 17th, the 24th, the 31st. We're not going to get this one until into January, which means we'll probably have the jobs report after this point in time. And the one for the 3rd will only reflect 2 days of December. So the 10th, the 17th, the 24th will be clean reports for just December alone. If they're coming in around the 220, 225 range, you're going to print a January jobs report that is going to be strong yet again. So you have to see this number probably get up to 275, 280 to be able to print a jobs report that then begins to solve the problem. Because remember, the Fed says you got to get this number down by about 100,000 a month. Which means job gains have to come in around 60, 70,000 a month, 80,000, anything under 100,000 to start helping as opposed to hurting. Anything in 200 or over is actually making things worse each month. So let's watch that number here. JOLTS, the job openings, 10,334,000. Hires were 6 million. When we think about job creation, 250, 260,000 jobs were created. Actually, 6 million people got hired over the month. Separations were 5.6 million. Layoffs were 1.4 million. Quits were 4 million. So if you have 6 million people being hired, 4 million people quitting, it's because they can get jobs rather easily, and chances are they're getting jobs at much higher wages, which is going, as long as this quits rate remains elevated like that, I don't know that you're going to get a reduction in wage gains month over month. And then you have other, which is 0.3. This other is just natural retirements. So you can separate from your job because you were laid off, because you quit, or because you retired. The estimate for retirements are about 10,000 people a day in the U.S. are retiring. So over the next year, some 3.6 million people will retire. 0.3 is 300,000. That is consistent with about 10,000 retirees per day, compared with about 6,000 people entering the labor force every day. Every day you're creating a deficit of about 4,000. Every day is a deficit of about 4,000. Remember, the Fed says there's a shortage of about 3.5 million. Well, every day, unless you can do something to moderate demand or to increase the size of the labor force, people entering the labor force, either most likely with immigration, you're going to have a growing deficit of about 4,000 a day. Now, when the jobs report came out, there was some talk about the continuing claims being at an elevated level, 1.6 million, because if we look through November, 1.4 went to 1.55, is now 1.6. So it was 1%. The insured unemployment rate was 1%. Now it's 1.1%. Let's put that in perspective. This is continuing claims, and here we are. I've drawn a red line right at where we are and drew it backwards. Notice that it is below everything all the way back to before 1990. So yeah, 1.6 million is higher than 1.498 million, and you can make the case that yeah, that has been going up. The prior year was 2 million, and even at 1.6 million, if you go back, even pre-pandemic was higher. It was higher all the way through. So when Powell says there is a long way to go, yes, there is still a long way to go. Okay, let's move over to housing. The primary mortgage market survey from Freddie, 30-year fixed sitting at 6.49, down 9 basis points week over week, but the Treasury, 10-year Treasury, is down by more, which means the spread between the 10-year and the fixed rate has increased. 15-year is 5.76. The from Q3 2022, if we look at transaction prices, the median transaction price was 454.9, which is down, I think, 4%, only 4% in the third quarter from the high. The median is down 4%. Housing price index month over month in September was 0.1%. It was actually a little increase. If we look at S&P Case-Shiller, it was down 1.5% year over year, up 10.4%, came in a little lower than expected. Mortgage apps down 0.8%, not much. Refis, that's no surprise, right? Look at your purchase index, up 3.79. Pending home sales, year over year for October, down 37%, but that's year over year. That would be expected when last October mortgage rates were less than half of what they are now. Month over month, negative 4.6%. From Realtor.com for the week ending November 26th, look at median prices. They were up 11% year over year, and they were coming down. Now they're up 12.2%, which is kind of the wrong time of year for that, because usually you have a decline in housing activity going into the end of the year. The number of listings went from up 49%, now is up 53%, but it's still selling at about the same speed. We're going to look at November housing trends shortly because that's in now. Have a look at this chart. This is the 30-year fixed rate mortgage in the U.S. minus the market yield on the 10-year Treasury securities using the 10-year constant maturity. And the spread is 283 basis points right now. If you go back in time, you got to go back to the great financial crisis to get a spread above the 10-year that is that wide. So that is extremely wide right now. Most of that width had to do with the speed at which the 10-year, at which the Fed was raising rates, and the increased volatility in Treasury yields. That's going to cause spread widening. If you have a 10-year yield that is dropping, you're going to have a 30-year fixed rate mortgage rate that is dropping. And if you have 10-year volatility, a yield volatility that is dropping, you will also have a spread that is dropping. Well, right now we're getting both. You're getting the 10-year dropping and you're getting volatility dropping. So mortgage-backed securities will benefit from lower overall yield and from tighter spread. Lower overall yield based on the 10-year because it is a spread above the 10-year. So if you think of a constant spread above the 10-year, as the 10-year goes lower, this will go lower as well. And spread contraction because of the drop in volatility. So I think for a while now, that has been a good time to look at mortgage REITs like Agency or Annaly. Agency, I think, is over $10 now. When they reported earnings, they dropped to well below $8, $7.50, $7.40. I picked some up at $7.80. Still have them. I'm more than happy to continue to hold them. And in fact, I bought some risk reversals on them as well. Let's look at our November housing trend. Now, when Powell was speaking, there was some question about housing and housing inflation, and he did say that the U.S. is in a long-term structural deficit as far as housing is concerned. So price decreases, I think, aren't going to be as significant as they were in 2008 because you had a surplus. Not only that, if you look at the average credit score by mortgage origination, they've never been higher. Plus, the majority of houses and the majority of mortgages were in place during the low interest rates, and housing prices in the last 2 years are up about 40%. So the equity cushion, even though the median price has fallen by about 4% nationally, more in some areas, but fallen by about 4% nationally, there's still a big equity cushion. So I wouldn't expect a 2008 scenario in housing to replay itself. I wouldn't look there for the external shock that causes a recession. This is active listing count. It's pretty much been going sideways for quite some time. And to put it into context, here is pre-pandemic. It is still well below that. This is total listing count, and it's following the seasonal pattern by dropping, but it's dropping along the lines of 2021. Again, there's pre-pandemic way up there. That's reflecting the lack of supply currently. Pending listing counts. This is in some form of sale. An offer is being accepted, but the deal is not closed. Yeah, that is approaching pre-pandemic levels. Newly listed homes dropping down considerably, but it's kind of seasonal as well, right? So it's falling along with the season. Days on the market still climbing, but again, pre-pandemic is way up here between, if you look across here, there's the 70 to 80. It's within the 70 to 80. And you're sitting here somewhere 57, 56, 57 days. Still about 3 weeks faster. This is rather an interesting chart. Anything above the line is a sort of negative. This is the active listing count year over year. You can see the active listing count increasing year over year, and this is the median days on the market. So as we move this way and upwards, anything below the line shows pressure in that particular market, but it only gives you the names of two particular markets. The whole chart itself is an image, so you can't actually click on one of these dots to figure out what it is. But good start. That was nice, but you know, other than a visual of, it says here 50 largest metro areas, other than a visual, it's not really giving very much. What are these dots over here? I'd like to know that. What's this one over here? Look at this, negative 24 over here, median days on the market, 24 days faster. What's going on? Who's this? Who's this? Wouldn't you like to know that? Median listing prices, way elevated. These three bottom lines, there's pre-pandemic. That's 280 to 300 in here for this time of year. Whereas you're sitting just below 420, 415 over here. This is a median listing price. It's not a transaction price now. It's just a listing price. The price reduced share, that is way above pre-pandemic levels. So homeowners who are listing their homes have reduced their price since the day they put it on the MLS. So they put it on the system, and then at some point they've reduced their price. That's how you track that. That is just a little above 2018 for that point in time. Reduced share versus active listing count. Again, nice attempt, but if we could just have some, you know, great, you showed me in a bunch of neat little circles, but I'm really interested which one this one is. I'm kind of interested in which ones are below the line, not so much above, but which ones, like this one over here. You've got fewer listings and they're selling pretty much about the same at the same pace. Well, what city is that? I would like to know. And maybe you get it from this long chart down here that you have to then look at each chart and you might be able to find the dot. But that seems like a lot of work. It would be nice if I just move my mouse over to it and a little dialog box opens up telling me what it is. But anyways, good first step, I think. Okay, Powell also mentioned exchange rates. Have a look at the DXY. It has basically just fallen off completely. 200-day moving average, 106.52. Well below that now at 104.55. The last line of support here, 105.11, broke through that. You have a line of support back here, 103.93, just a little above that. 102.8 is a 10-year support on the DXY. If you look at a long 10-year chart, there's two peaks at 102.8. Another pullback here creates support at 101.65. And then you have your period of resistance over here, which will be support at 99.17. But it is really just coming down right now. I expect that to continue. The driving factor for currencies, the big driving factor for currencies in the short term are interest rate differentials. And the Fed is slowing. That seems to be the consensus that is embraced by the market. So U.S. will be under pressure for a while. This is not going to help the Fed's case, because as the US dollar goes down and commodities are priced in US dollars, commodity prices are going to go up because there is a trade deficit for the US. Import prices are going to go up. Both of those are negative for US inflation. Okay, let's look at the VIX. This is down here is a 3-year chart of the VIX. This is a chart of the volatility of the VIX. It's the VVIX index, volatility of the volatility. So that if you were going to buy options on the VIX index, you would need some measure of the implied volatility of the options on the implied volatility of the market, if you can follow that. Breakdown over here. You have 3 closings below support, and this upward sloping line, this upward sloping trend line was support. You've had 3 closings below that. We have a 1949 support coming up. We're at 1907. You break that. Next one is 1653. And look very closely at the 50, 26.9 versus 26.3. Given where it is, it's just a matter of probably a couple of days to a week before you have a death cross. A death cross is where the 50 drops below the 200-day moving average, which is a big signal of a downtrend. So VIX is dropping. Not only that, but the volatility of the VIX is dropping as well. And I've put its current level here and drawn a line back, and you can see that only a few times, January 19th, July 19th, has the volatility of the volatility been this low. So we are below 20 on the VIX, which makes selling premium on the S&P undesirable. VIX is sitting below 20. The volatility of the VIX is low, which means buying calls on the VIX is inexpensive. But be careful here. It is not the same as buying calls on any other stock price that you have. You really have to pay attention to the futures price on the VIX. Kind of complicated. So I've never gotten involved with options on the VIX itself, that if I felt that I wanted to buy VIX calls, I would be buying SPY puts instead, because it's basically the same relationship, that as volatility tends to increase, if you bought calls, you'd get a payoff. As volatility increases, it's typically because of the market decreasing, you'd get the same result. But if you are comfortable buying calls on the VIX, you can go ahead and do that. I would be looking 4 to 6 months out, but keep in mind you're going to have to price them based on where the futures curve happens to be. So with the S&P performing the way it did last week, and especially overcoming the negative information we got out of the jobs report, negative in terms of what we expect the Fed to do, and when we look at what the market did and overcoming that, and look at volatility ending the week on the low point. This was a low close for the week at 1907. That means on Friday volatility dropped even more, and that the volatility of the volatility is also dropping. This is not consistent with an expectation of a recession. This is consistent with the expectation of falling inflation, unemployment not rising that much, and a soft landing. As Powell said, that a soft landing seems like a highly plausible outcome to him, but is not consistent with the drop in real yields and the increase in inflation expectations if you think the drop in real yields was a result of inflation expectations. Then inflation expectations are too high. But if you think real yields, the drop in real yields was the result of recession expectations, well, then this does not square with that. Okay, let's look at SPY. We got to figure out which way we think this market is going, and based on everything that I'm seeing, where the VIX is and how the market closed last week and what's sitting in front of us, I don't know for the week coming up if there's a downside catalyst. There is an upside catalyst, which is nothing more than momentum. You know, we've gone up, we've closed above the 200-day moving average, so why not go higher? and I seem to think that the higher we go, the more valuation will become an issue. But if the soft landing and the Fed pivot narrative is back front and center, well then, who knows what valuation is? Earnings could be up 20% next year, not down, not flat, but they could be up, right? So when you have a narrative that is fantasy based, it doesn't, you could say almost anything. And I think this idea that the Fed is going to peak sooner and cut rates into the end of the year and achieve a complete soft landing and everything will be fine, I think is complete fantasy. But the equity markets seem to be okay with that. Finished at 405.93. 200-day moving average is 403.74, and I think beating the 200-day moving average had a lot to do with the buying. I think there was probably a lot of program trading to buy the market above the 200-day moving average, or some buy stops to close short positions above the 200-day moving average. So whether it has more room to run other than just, oh, we beat a technical level, so there's some technical trading that needs to be done, not fundamental, I don't know. The downtrend here put upside resistance at 405.20. We're over that. 18 times the forward earnings was 403.69 on the SPY. We're above that. And we had an upside gap over here. And since all gaps were filled, we would have expected it to be filled. It was filled intraday on December 1st, so it's no longer a technical feature of the chart. So we're sitting above what was resistance before. The next area of upside resistance fundamentally would be at 19 times forward earnings at 426, and the August high sitting right around 430 on SPY, which is $25 more than where we are now, or roughly about 230 to 250 points higher than where we are now. And technically, there's nothing in between there. So what has to come into play is some kind of fundamental rationality saying, are we really prepared to pay 19 times forward earnings for a low growth environment, a low growth to no growth environment? Now, if the soft landing narrative starts to gain more steam, that starts to have a life of its own, because it'll start off as a soft landing. It'll start off as 50 basis points and 25, which will then go to, we could squeak out some earnings growth next year, not just 0% growth, but maybe 10% growth on earnings, and maybe there'll be no 25 basis point increase to inflation will disappear by March, and maybe by June we'll have a 50 basis point cut to, you don't know how far those narratives can go because they end up getting a life of their own. Every version of it takes one step further into fantasy, and I think that's where we are right now. This idea that, no, we're going to get a soft landing. Unemployment's not going to have to change much. We're just going to put the labor market in balance. Everything's going to be just fine. We're going to get a soft landing. No one's going to lose their job. We're not going to get negative growth, and earnings are going to grow from here, and we're in the start of a new bull run because we closed above the 200-day moving average. I think that's pure fantasy. Now, you may disagree. You may say, "Oh, you're being a little bit harsh here. You're not opening your mind up to the possibilities a bit more." China is is relaxing some of its COVID restrictions. Sure, it's not complete opening of the economy, but it's not lockdown anymore. That will just increase over time. Europe has shown its ability to adapt to the Ukraine war, and I said this when it first started, that the longer it goes on, the more it will become normalized and the market will just see it as backdrop. It won't be a risk factor anymore. It'll just be something that's going on. The volatility in both treasuries and the market are dropped. What more do you want? Right? What conditions are you possibly waiting for to say, okay, up we go? I mean, you could make that argument that maybe I'm still just a little bit negative. You could also say, like you said earlier, the inverted yield curve doesn't create the recession. It only creates the conditions for a recession if a shock happens. Well, what if no shock happens? What if we move from a slow growth regime to a high growth regime? And then a shock happens? Well, the economy can handle it. So maybe this is a bull run. Doesn't seem likely to me. That's just experience and intuition. I look at this and I think it doesn't seem right. You see this uptrend? You see how sharp this uptrend here is? This is not sustainable. That type of uptrend in a low growth environment is not sustainable. You typically get those kind of sharp uptrends in bear markets. When you get bear market rallies, they're usually sharp and they have that kind of steep slope. Everything sort of suggests to me that we are entering a period of lower earnings growth. You cannot have these kind of wage gains without prices going up to protect margins. So if you think, no, earnings are not under pressure, margins are not under pressure, they can continue to expand, then prices have to go up if wages are going up, which means inflation is nowhere near done, which means you're not going to get a cut in rates. You're going to go even higher than what the Fed thinks higher is at this point in time. If prices don't go up, we clearly see wages going up, margins have to go down, which means EPS is way too high. Energy has been the driver of earnings for the last year, a big driver of earnings, and we see energy prices coming down. Well, if energy isn't going to be the driver of earnings, what's it going to be? I can't in my mind find the scenario that justifies a 19, a 20, a 21 times earning. I can't. So I'm still sort of thinking that there's limited upside. I'm not saying we're going down 500 or 600 points, but I think there's limited upside at this point. On the downside, this steeply upward sloping support line from where we are now gives support at 397.14, but you have support at the 200-day moving average of 403.74. To start thinking about where support is on the downside, I think technically you would have to close below the 200-day moving average. I would like to, and if that's the case, it would be even more clear, not that I would like to see it, but even more clear if it was done on higher volume and the close was significant enough below that, like at 397, 396, even closing below the uptrend. I don't know what would get us there. That's about 100 points lower on the SPX here. 381.26 is 17 times earnings, which I think is probably the right price given the growth environment that we're in. I think somewhere around 38 to 3,900 on the SPX is, if we were in that range, I would say I'm completely undecided. And I believe the equity market is being rational at this point. Right now, I think it's being a little irrational. You have a downside gap in the chart over here, 381.14, and if we believe that all gaps are eventually filled, we have to think that at some point the 381 will be filled, and your 50-day moving average is way below you at 380.32. Look at implied volatility percentile. In the last 13 weeks, 0, the lowest. Last 26 weeks, 5%. In other words, 95% of all observations in the last 26 weeks were above where we are now. 18% on the 52-week. There's no premium. So here's an interesting play to look at. Go to April. At least this is the one that I'm thinking is quite attractive. The 395 put, which is $10.93 lower than where we are now, costs $15.54. I would probably want to be long this put. In other words, I'm not selling anymore. Premium is too low. You don't sell with low volatility. You buy with low volatility. You sell with high volatility. So if you're buying options, puts at this point, and the market does sell off, you get two gains on your put. You get the delta. You get the delta increasing on the put and the value increasing simply because the market is moving closer to your strike. Plus, it goes up even faster because as the market is dropping, implied volatility increases as well. So you can do really good if it works out. But I want enough time. When you buy long periods of time. When you sell short periods of time. I could finance that with the 420 calls at 1567, which is 1407 higher than where the market is right now. So I'd have $14.07 of upside protection. And the market only needs to fall $10.93. I would do this first. I think you want to step into these sorts of trades. Buy this one. Let's say the market goes down. I'm making money right away. If the market goes down, these puts are already going to start increasing. And then I get to assess why the market is going down. And if I don't believe why the market is going down, I say, I don't see this lasting. I can make a quick trade and turn around a quick profit because I don't expect it to continue. But if the market is selling off and it seems like it's more market wide and that there is a consensus that we've gone too far, then I would let them hold and I would stay there. If on the other hand we do rally after I bought these, and since if the market goes up, what happens on this? The delta goes down, which means I will lose money at a slower and slower rate on the 395 puts. If the market goes up, rather than the 420 calls, I might be able to go to the 425s, I might be able to go to the 430s or the 435s to sell those calls to pay for these. So it gives me a better strike price on the upside for upside protection to get cash neutral. Remember now, if I sell the 420s to pay for the 395s, I'm cash neutral. That's all it makes me. It doesn't mean I'm going to make money. Doesn't mean I'm not going to make or lose. It just means I'm cash neutral. It allows me to be higher on my strike prices to get cash neutral. So that if it does get 200 points ahead of me, by the time it's done, I'll have my calls put in place that completely pay for my puts, and as long as it doesn't go any higher from that, I'm okay. It doesn't need to go down below 395 at that point for me to at least just break even. So I would step into a risk reversal that way. Here are the things that I'm fairly convicted on. Agency. Mortgage REITs, agency and annually. I think on any pullbacks at this point in time, keep your eye on the 10-year treasury. If you see the 10-year treasury rising for the day, let it rise. Let it rise. If you think the 10-year treasury is going to keep rising in yield, just keep waiting. And then when you think, okay, maybe the 10-year is going to start pulling back at this point, that's when you would buy agency. It is going to move with the 10-year treasury. It is going to move with treasury volatility. And I think agency wins no matter what. If we get a soft landing, the 10-year yield will drop, spreads will contract, and that's only bullish for agency's balance sheet. If you get a hard landing and the economy goes into a recession, agency is not originating mortgages. They're holding a security that does not care about the state of the economy. It only cares about rates and spreads. Well, if the Fed has to drop rates on the front end of the curve, the 10-year treasury is going to drop. That's only good for agency's balance sheet as well. So mortgage REITs that are in agency MBS, such as agency or annually, I think long positions on them make a lot of sense. I am long REITs right now, especially apartment REITs, because where are you going to go? Housing affordability is not in the sweet spot right now. You've got housing prices that haven't pulled back enough to make up for the increase in mortgage rates. So if we look at apartment REITs right now and you look at their turnover of apartments, they've never been lower. In other words, people who are in apartments are not moving out of those apartments. So I'm long REITs, but to protect myself there, I am short calls on IYR. BHP, Pick and Rio, I still got that. I still think materials make a lot of long-term sense because there's just not enough mines out today to meet the demand for this transition to a green economy. The metals that you need simply, they're in the ground, but they don't exist in a way that you can get them out. So there's going to be elevated prices on that for a long time. Not only that, as the US dollar drops, what happens? The price of those commodities increase. Copper is up, 10% in the last week? 10%? Well, that just goes right to the bottom line of mining companies. So if we expect further dollar weakness, you got to like the materials sector. Home builders, still like home builders. HXB, which is the home builder index. I have specific home builder names and the HXB because there is a structural shortage in housing. That's not going away. If you do get a soft landing, mortgage rates are going to drop, which will only increase activity in the housing market. We're seeing the purchase index over the last week was positive, even at elevated rates. So I think that you know, if you are getting that soft landing and mortgage rates come down, home builders will you know, be advantaged by that. If you do get a recession and you do get the economy really cracking down, rates will drop on the front of the curve. The 10-year yield will drop. It may cause the spread between the 10-year and the mortgage rate to increase, but I think you'd end up with lower mortgage rates overall. And I don't think unemployment would rise that much into the next recession because of labor hoarding. So we have to think that, oh, well, what if you get 6% unemployment? 6% unemployment is still 94% employment. So I'm not too concerned about the home builders because I think that we're in a slowdown going into a recession. I want safer parts of Delta, XLV, XLP, XLU. That's healthcare, utilities, and staples. And I'll combine this long delta with net short delta on SPY. Long the Canadian, long the peso. Peso has been a winner, an absolute winner so far, and I think it'll continue. I think I read somewhere that Canada, US and Mexico, the trade consulates are doing some kind of presentation to demonstrate the attractiveness of investment in Mexico right now. So Mexico is actively taking advantage of this friendshoring and nearshoring trend that's going on. I think they're the natural recipient for this because their labor costs are well below what China is right now, and they're friendly, and you don't have a seat across, and it makes Mexico the land of opportunity for a while, for the next, could be 10, 15 years, which means your migration up from South America could end at Mexico. You have huge population once you get to Mexico, Central America, South America, that are in economically depressed countries. Why not help them? Why not do that? And I think you know, North American companies are starting to see that that makes a lot more sense. So I'm going to continue to stay long the Mexican peso. Also, I sold June ES, the mini futures, is the same as shorting 500 shares. For every contract you sell is the equivalent of 500 shares of SPY. I don't want to sell calls on the index anymore. The premium just isn't there. So if the premium is not there, you know, rather than taking a convex security, I'll take a linear security, and this is a linear security. It's at 41.53 versus 40.71 only because the interest rate is so high. Remember, the forward price is the spot price, RT. Well, you'd have to take the dividend yield out of there, so R minus Q to the T, and since R is so high, the price on SPY keeps going up, the dividend yield gets lower. That's why the curve, the forward curve, is that steep. So you're short at 41.53, and because some of that is just because of the higher interest rate. So I am short on June ES at this point, and that's where I'm sitting. I'm more likely to buy puts on the index, and if we get a rally, sell calls to make myself cash neutral. I'm going to continue to maintain my long position in what I'm holding and modify my short position based on what the market is telling me, but I do not believe that any upside here can be maintained. I've already told you my fixed income trades, and that's basically where I'm sitting. Let's have a look at the week ahead. Monday, December the 5th, you get building permits in Canada for the month of October. And in the US, 9:45, the S&P composite PMI and services PMI, I don't think is going to be as important as 10 o'clock, the ISM non-manufacturing PMI. We'll see what the market thinks about that. You know, you could make a case that the market could sell off, whether it comes in stronger or weaker, and you could make the case that the market will go up, whether it comes in stronger or weaker. So it's a matter of waiting to see what the number is, and the more important part will be, well, what's the market reaction to it? That will tell us what the market is thinking. Factory orders for October, that's more backwards looking than the PMI. The PMI will be an important number. In December, balance of trade for both Canada and the U.S., and we should get import-export prices as well. I don't expect there to be a lot of surprise here. This is for the month of October. The U.S., the DXY, the U.S. dollar, really didn't start giving up ground until November. So the November import prices paid will be an important number to see when that comes out. Mortgage applications on Wednesday. Bank of Canada interest rate at 10 o'clock on Wednesday, expected to go 50 basis points. The move is not as interesting as the comments after. So we'll keep an eye out for that. But that's key risk for levels in the US dollar versus the CAD. Consumer credit on 3 o'clock on Wednesday. This is put out by the New York Fed. Typically they increase, consumer credit increases. The last report we saw for consumer credit, as I went through it, there was nothing interesting at all to talk about. The amount of credit increased, which means the money supply increased. Whenever you have an increase in credit, the money supply increases. But is it increasing at a slower rate? And is the delinquencies and in different credit markets increasing, even though the last report we saw, they were all at much lower levels than pre-pandemic. They have been increasing. They noted they have been increasing, but still much lower than pre-pandemic levels. I don't know that this is going to change many minds out there. We're going to start paying more attention to this. This is becoming more important. I think these, instead of medium, they should be important. Now, continuing jobless claims and initial jobless claims, let's watch each one. The forecast is for 230. The closer it stays to 220, 225, well, the more you're going to get a jobs report in January that is going to be another repeat of December. Pretty much what the Fed does not want to see. Next day, PPI on Thursday. This will be our first look for November. It's not the CPI, it's PPI. The CPI comes out the week after on the 13th. But it gives us some indication of what November looks like. Forecast is for 0.2. If that comes in hotter than 0.2, well, we'll see how the market responds to that. Michigan consumer sentiment. And that's about it for the week. So big risk event here, I think, is, well, I think you could bring them down to 2 really, is the Bank of Canada interest rate decision for Canada, and probably PPI will be the bigger one in the US on Thursday morning. And that's about it. If you're, sort of flipping a coin on the equity market up or down, so am I. I honestly just don't know. I don't believe the upward move at this point in time. However, it's not a matter of what I think. It's what I think the crowd thinks. And I think the crowd thinks that the soft landing is still in play and we finished above the 200-day moving average and there's no upside resistance until 425 to 430. So that could happen. Anyways, have fun.